I guess that's probably a good way to start it then. How did you actually get into the body corporate finance industry? Like, what were you doing, pre this?
Well, it's a bit of a boomerang story, really. So when I started in banking back in 2006, my portfolio was predominantly body corporate managers, working for Macquarie Bank in Sydney. We had a large portfolio of body corporate managers, so I was very familiar with the industry. The bank then released the early stages of its body corporate lending product. And then my career's sort of gone into a few different places since then, and sort of 4 or 5 years ago I left banking and moved into the client side advisory, so working for clients. And then pre-COVID we were asked by a couple of New Zealand clients to do some work for them, and part of that then led to this question from one of our clients: we own units in a building in Queenstown that suffers from weather tightness issues. Do you know anything about body corporate finance? I said, well, matter of fact, we do. We've done a number of them in Australia because it's a bit of a semi-mature industry. But there was no one in New Zealand that was doing it. None of the lenders from Australia had made it across the ditch. And this client said to us, well, can you help us with our problem? It's a pretty prominent lakefront development, and it had a big weather tightness issue that, pleasingly they're a long way through remediating now. So we spent 9 months working through the nuances of the New Zealand legislation, understanding how the market works over here, and really what the funding requirement was. And within 9 months, we'd worked out what the funding structure had to be, identified the right capital partner to fund the deal, and had an approved facility ready to go for the body corporate in Queenstown. So it's been a bit of a long-term scenario, but it just ties in well with what we do in New Zealand, which is solving complex and unusual funding solutions around real estate. We started in New Zealand trying to solve for modular development and modular construction, and we've done that, and we've done a couple of projects in that space. So continuing with that theme of trying to help solve problems that existed that shouldn't exist still in New Zealand is kind of where we focus from a mod finance perspective.
I guess in a weird sort of way, by osmosis, you would have learned quite a lot about the body corporate industry when you were dealing with the body corporate managers over there. So you're not coming into it totally blind. You kind of have a good understanding of how things work.
Absolutely, and having a number. I think we had 40 or so clients that were body corporate managers in my portfolio. You get a really good appreciation for the challenges that the body corporate managers face, and what their whole business is about. And then combining that with what we do from a mod finance perspective, which is niche real estate finance, we're able to bring those two, one knowledge base and one skill set together, and deliver a solution that, frankly, we were pretty surprised hadn't been developed in New Zealand up until now.
Why do you think that is? Do you think it's always been the realm of the big banks over here, or why do you think it hasn't been developed further in New Zealand?
It depends on who you speak to. So part of it is the uncertainty. So number one, the banks won't get into this, and they don't, frankly, they don't get into it in Australia either, predominantly because it's consumer finance in Australia. It's not New Zealand, it's deemed wholesale finance. But banks want high certainty, low capital requirements. They just want to get paid back their money, and it's a challenging space. As you've no doubt seen that the biggest issue around body corporate finance is the price for the project starts at X, but then as the project gets underway, X turns into Y really, really quickly.
Yeah, sure does.
So the ability for a bank to get into a project and have certainty that it's only going to be what they're lending is challenging. And we've spoken to a lot of the banks about this space. There's been a whole bunch of consultants in the industry over in New Zealand have been down the bank path, and it's just not a place that fits within the banking model, which is why we had to get involved and develop a solution from scratch.
Yeah. What were the challenges like coming into say the New Zealand market from Australia? Like, was it harder than you thought, or was it easier than you thought? Or, what were the main challenges there?
Well, we made a conscious decision as a business that when we entered the New Zealand market, we weren't going to come and do what others were already doing. So there's plenty of firms and plenty of people in New Zealand that already do real estate finance in one way, shape or form. Where we felt we could add value was using our skill set and knowledge base to solve unique funding requirements. So it wasn't so much the challenge of coming in and working out what to do. It was the challenge of coming in and using the Australian experience around body corporate finance, but ensuring that we understood the New Zealand landscape, because the funding requirements between Australia and New Zealand are fundamentally different. Australia is more around general repairs, bit of maintenance, a new lift, potentially some balcony issues or some concrete cancer, those sort of things. And the loan size is, we've been told, somewhere between, the average loan size between $1.5 and $2 million. You come to New Zealand, the number one requirement for funding is around weather tightness and remediation projects. That's the requirement that's right here, right now. In a couple of years' time, it's not going to be weather tightness so much as solving for seismic upgrades. So that's another train coming, at pretty full speed towards the body corporates. And then when you start digging into weather tightness, we're talking big licks of cash here. So I said before that the Aussie experience is sort of 1.5 to 2 million on average. Some smaller ones, some bigger ones. In New Zealand, most of the deals that we've looked at have been between $5 and $50 million funding requirement.
Wow.
So they're large scale, almost full refurbishment projects, or you're pulling off a curtain wall, or you the Queenstown project was full strip out and start again. Leaving the main structure in place, but full strip out, all new curtain wall, bathrooms, kitchens, everything.
Wow.
So it's almost like a construction project in its own right rather than an upgrade of the building. So understanding that was number one. Understanding the differences in the body corporate legislation, so the Unit Titles Act here is very different. And we worked with 3 different legal firms. We had Tier 1 commercial lawyers, we had the litigation firms that specialise in leaky buildings, and we had some banking and finance firms that worked on the more the owner's loans and some of those sort of structures. And it took us 9 months to get right up to speed and get to a point where we had a funding structure, a funding solution, and had identified all the risks, knew how to mitigate them, to be able to be in a position where we had a solution that investors and capital partners were willing to participate in.
Yeah, well, I mean, that's that sounds like quite a short time frame, like 9 months. Like I was expecting like a couple of years, but you guys must have done a hell of a lot of work in that 9 months to get up to speed. Like there must have been a pretty challenging time.
Yeah, look, it was, but I think we had a bit of a running start because we had completed body corporate loans in Australia. So we weren't coming into this space fresh. So we already had a knowledge around the basic structures that can work and what does work, what doesn't work. The work really focused on the legislation and understanding what the differences are, where it could go wrong. And we were lucky that we had, the body corporate we worked with on that transaction in Queenstown were exceptional. So the committee was full of highly intelligent, highly articulated and committed individuals that were smart enough to know what they didn't know and got the right consultants in. The contractor that was on the project, has a whole business unit built around remediation projects, so they were high quality contractors as well. And the lawyers, we invested heavily in legal fees to get that part right. So it's a combination of all those things coming together, and it was pretty much the only thing we were doing for that 9 months, because to your point, there was a lot of work to get done.
It's an interesting point you made about the committee. Like they sound like they're a pretty sort of commercially savvy bunch, and that could be quite refreshing because a lot of the times these committees are made up of people who are they've all got their own lives and livelihoods, and they don't tend to think along the commercial lines or the bigger picture. They can get a bit narrowed in on on their own little issues, or don't think about the big box and only think about the small box. Working with a committee like that must have been quite a refreshing change, I'd imagine.
Absolutely, it was almost like dealing with a private client, a private developer, because each of the individuals on the committee, this was pretty much their full-time requirement. We're talking about a big complex, a couple of hundred units, and they were doing this predominantly full-time.
Yeah.
For three of the committee, this was a full-time gig.
Wow.
Being the liaison and the go-between the owners and the contractors and the consultants, the lawyers around the litigation, all of that sort of stuff. So they had taken it on as a full-time requirement, which it needed to be, given the size and the complexity.
Yeah. Going slightly off track, but I've always been a little bit critical about the body corporate industry from that point of view, where those people probably had jobs and lives that they were doing at the time, but then all of a sudden their lives go on hold for a bit. They're doing all this work. People at work, tapping away on emails for body corporate stuff, and they're going, "Oh shit, I've got my job to do, but I've got to fire this email off." And the industry it's a little bit invasive in that way. Like it's because a lot of it is communicated by email and stuff. It's easy just to do a little bit while you're at work, but the whole industry must pinch a fair bit of time off the economy, especially when you've got projects like that happening. But
and I think that's one item that the recent changes to the UTA are starting to reflect, that the responsibility and fiduciary duties of committee members are now somewhat similar to a director in a company. So I think you will start to see a change in the composition of committees as those changes flow through the system. Because at the end of the day, a body corporate is grassroots politics. You've got a group of individuals that have either been voted in or elected by the constituents to represent their interests for the benefit of all, and that's effectively what a body corporate is. So, if you're dealing with a body corporate that are highly articulate, highly intelligent, and one thing I left off last time was they all had excellent corporate experience, so they understood how to run projects of this nature. So those owners in that complex should be forever grateful for having those owners stand up and run the project. And we see, over my career in banking land and this stage in my life, we do see a range of committees.
We
see it. It's just part of the nature.
Yeah. And I think that the ability for them to understand governance is a key. Because a lot of the committees that don't understand governance as their role will try and get a bit too involved, and they're just they're being good natured and just doing what they think is best. But quite often the best thing that they can do is stand back and let the professionals deal with the issue. We see that quite a lot, where someone will just get too involved in a project. I wanted to ask about, at what stage, like when do you guys actually get brought into a project? So if we go right to the start of it, where they say, right, we've got an issue, where do you guys come into the project?
We'd like to be involved as early as possible, and that's not from just for the sake of being involved, but just like a contractor wants to be involved from the start to make sure that the design, the engineering, the architecture, the buildability all makes sense for the journey. From our perspective, we can give guidance and or funding to a body corporate all the way along the journey. So if we're brought in early on in the piece, where it's, hey, look, we've got this project, we're not sure what it's going to cost, can you give us some advice? We'll come in and we'll sit with them and talk to the body corporate, talk to the committee, talk to the contractor, and get an understanding of what the journey's likely to look like. Put some options forward, get some feedback from them. If they're starting out on the journey, ultimately the owners will need to fund the initial level of work. Because for us, the key thing is we need to know exactly what the scope is. We need to know exactly what the defects are, because we can't be in a position where we fund a level of work and then, for instance, the cladding comes off and then there's other defects, other, membranes failed and there's passive fire issues and your remediation goes from 20 million to 40 million. We just can't be in that position because we don't take equity risk. So the earlier we're involved, we can give some guidance on how best to structure the funding, whether it be levies entirely, debt and levies, or just debt. And we can work with the committee all the way along the journey. That's ideal. Invariably, given we're entering the market more recently, that most projects are already, the train's left the station. So we're coming into these projects part the way through. And we still provide that funding advice and guidance to the owners. And invariably, a lot of the conversations we're having now are, well, we're going to raise levies to a certain level, but we think we're going to have a shortfall. Can you fund the shortfall? That's perfect for us because the commitment by the owners to fund the original work, great, and we're coming in to top it up, perfect. There's other conversations where we're going into tenders alongside contractors where it's going to cost X, here's how you're going to fund it, and we can provide them options around whether we fully debt fund it, whether we put a bit of debt and a bit of levies together and provide them options and work through what works best for them.
Right. Yeah. Yeah, I've always wondered where the finance stuff starts happening, because I guess and it's quite an emotional time for people too, isn't it? It's their livelihood essentially tied up in one of these buildings, and there's some huge decision making processes they have to go through along the way. Potentially, a lot of people aren't thinking straight, or thinking with the best best outcomes and stuff. Prior to you guys coming into the market, where would they have got their funding from previously? Would they have just had to go to their bank, or how would they raise the funds previously?
Well, I think the answer is it depends. So in any body corporate, there's different cohorts of owners. So you might have a cohort of owners that are, let's call them financial, and have assets outside their residence.
Yep.
You'll have other owners that's all they've got. And depending on which cohort they fall into, it's going to drive their ability to make the levy payments, particularly if they're chunky special levies. So for those owners that have assets outside that they can either liquidate and sell or gear up against to raise the funding, great. For those that they only have the property, depending on the status of the building and the perception of the building by the banks or the lenders, they may or may not be able to get funding against their dwelling. So you hit the nail on the head when you said it's an emotional position, and it is, because a lot of these people have bought these apartments. Problems have arisen after they've gone in, and frankly, the cost of the project is just beyond the financial resources of them as an individual or from the body corporate as a cohort. And one of the reasons we're really keen to get the word out and help as many owners as we can is because it's a real tough time for these guys. And if we can play our part in trying to resolve a financial and highly emotive situation for them and get them from where they are now through to the point where they've got a unit in a building that no longer has, for example, weather tightness issues, that then allows them to, one, sell the unit for full value, not heavily discount, or two, access traditional bank finance to restructure their own internal finances to set them on the pathway forward. So we're here to play a part to get them between, I've got a problem that leaks like a building that leaks like a sieve, through to the point where I'm just a normal lender, a normal borrower from a normal bank. That's the part that we play and that we'd like to do more of.
I guess I'm going to get a little bit nuts and bolts about it, because the whole mechanism kind of fascinates me, just from a point of view of seeing how the money's raised, where it goes, how the bills are paid, etc. Because once the problem's identified, they raise their funds, they get the contractors in, contractors start work, and then they'll do
Progress claims.
Progress claims. Yep, that's the one. So where does the money that they've raised, where does that sit, and then who pays the bills? Is that something that you guys do, or does the body corp manager do that?
Yeah, so a couple of parts. We would anticipate that most body corporates will be contributing levies into the long-term maintenance fund. Now, whether that sits alongside a debt facility or before a debt facility, that just happens in the normal course of business that all of your listeners will be familiar with. When it comes to the loan component, we will approve the loan, and that funding is available to meet the agreed cash flow. So we'll sit with the owners, the committee, we'll sit with the builder and identify what the cash flow forecast is. We'll then align the drawdown profile of the loan to be able to meet those obligations. And every time there's a loan drawdown, that money gets deposited into the individual trust account, not a pool trust account, but an individual trust account managed by the body corporate manager.
Right.
And then the body corporate manager simply uses those funds to pay the contractors as they would normally, as if the funds had come from a levy.
And so the debt sits against the body corporate?
Correct.
Or, so it's not against each individual owner?
So that's a really important aspect. So in what we do, the body corporate is the borrower. The owners are not the borrowers. So what that means is we're looking at the body corporate's ability to meet its repayment obligations, and in that effect, it's like a council. It's got the ability to raise levies from its owners. So there's a real power in the ability to raise your own levies, and that's the only security that we look for.
Right.
So the ability to levy and control those levies in the event that the body corporate doesn't do what they're meant to do. We don't require guarantees from the owners, and we don't take mortgages over their property because that's the individual's responsibility. We're lending to the body corporate, so it's two different buckets. So this is effectively an unsecured loan to a body corporate for the purpose of remediation, seismic, general upgrades that the owners pay for through their levies.
Yeah, cause I guess a body corporate, I've never heard of one going bankrupt. You know, they, like you say, they're like a council where they can raise and control the rates or the levies or whatever. How do you have any sort of criteria that you look at when you do, assess the health of the body corporate? Like, do you look at their few previous accounts or their sinking fund, or how do you actually make that decision?
So it's, our background's banking, so it's similar to any credit assessment that you would normally deal with at a bank. But of course, we are looking at the historical financial performance. Are they raising levies? Are they getting paid? Arrears is really important for us. So we want to know what's the arrears level like? How old is it? And particularly if there's some problematic owners that have just either have an unwillingness or an inability to pay the levies, what's the committee doing about it? And the Unit Titles Act provides a very, very clear mechanism for a BC to recover levies that are in arrears, which we would hope that they would be exercising if there was a need to. But then we also look at some key metrics. So we want to understand what type of building it is. Is it predominantly owner-occupier? Is it residential? Is it commercial? Is it tourist? Because the underlying drivers between whether an owner will continue to make payments or not is driven by the type of property it is. We then have a look at things like the average debt per apartment, and you start getting into some of these bigger projects, you start looking at numbers where on a straight line, not in accordance with the allocation of units, but on a straight, dollars divided by number of units. We've actually had to say no to some of the funding requests because you're putting these owners in the gun for $1 million each, which is just not. It's not economically viable, and we have no interest in participating in a loan where the debt requirement per owner is significant. So we want to make sure that the notional debt per unit is affordable. So we'll look at things like that. We want to make sure that the project actually makes commercial sense. And when we started on this journey, we unfortunately got calls from a number of buildings, particularly here in Auckland, where the funding requirement, where there's no chance of litigation, there's no FAP, there's nothing, the funding requirement exceeded what the value of the building would be worth on an on-completion valuation. So you're sitting here just saying, we'd love to help you, but it just makes no sense. And it's sad to deliver that message to people, but it just makes no sense. So you want to make sure commercially the project works. You want to make sure the contractor knows what they're doing. So there has been instances where, my cousin's a builder and he's going to come and do the work for us. And when you start pulling the string, the cousin does extensions, and the owner's trying to push his cousin to get the job on a $10 million weather tightness project to remove a curtain wall. It's like he's never done anything like it. So you've got to make sure the contractor knows what they're doing. And we have some preferred builders and contractors that we would like to see on projects because of their track record. And the other big qualitative factor goes back to who the committee is. So if the committee, such as the one we referred to before, have got the right type of personnel and have engaged the right consultants to make up the knowledge gaps, great. If, however, you've got a body corporate who feels that they know how to fix the project, but they haven't done it before and they have no experience to construction whatsoever, that's going to be hard for us because it's like any development project. You're reliant on the expertise and the skill set of the individuals driving the project to get the project finished so that we can get repaid. That's pretty key for us.
Yeah, that's it's interesting when you said about the nepotism involved, where I've got a mate or I've got a family member that could do that. Because that's another thing that you see a lot in body corporates is, if you get quotes for something, for some sort of maintenance or job, there's always someone on the committee that will say, I know someone that could do that for cheaper.
Yep.
It's like, mate, it's not necessarily the best outcome. Cheaper is not necessarily better. And 9 times out of 10 it ends up not eventuating because they can't be bothered actually taking the liability of it on. Because you guys are would you say you're controlling the purse strings in a way, or because you're funding the project? Like, do you actually have a fair bit of say in who is involved? I mean, you were just saying before about the different parties involved. Can you guys ever step in and go, no, or yeah, or let's change this person or anything? Like, do you go that far in?
I think that would be case by case.
Yeah.
And in any loan facility, there's events of default. So one of the key things we need to get on an ongoing basis is the PCG reports. And generally, if it's a big complex project, myself or one of my team will be attending the PCG, because that's where we're going to get the early read that things are starting to go off track. But a condition of the loan will be that the contractor is satisfactory to us. So we're not even going to be in a position where we're backing a contractor where they're not acceptable. It has to be acceptable to us, and we have to sign off on them, which means we're having a look at, like any development project or construction project, we're having a look at their balance sheet, their strength, their track record. So hopefully we're going to be in a position where we've already picked the right parties. But if an event of default occurs, then yes, we have the right to go in and start making some changes, which will be for the betterment of everyone, because the whole goal is we need to get the project finished before we can start getting fully repaid.
And so in your time doing this, have you sort of come across or seen or noticed some particular common trends or challenges amongst the clients that you're dealing with? Are you seeing the same sort of things popping up, or is it different case by case?
Oh, look, they're all different, but they generally have a series of similar characteristics. So number one is the building is in that bad a shape that we can't help. Number one, and that's I don't like having to deliver that message, because no doubt they've already heard it from other parties. But if it's going to cost $80 million to fix, but it's only worth $60 million at the end, that doesn't
make sense.
It's negative. We see scenarios where you see this fraction, or you see factions created within the owners, where one group just want to get on and do it. Then you get owners that say, I'm not impacted, I just want to do it under maintenance. And that's great for them, but their living room's not leaking every time it rains. So we see that scenario a fair bit. And a Section 74 is fantastic. We would love to see a Section 74 on any big building because it brings everyone together. Everyone's signing up for the same purpose, and it gives the body corporate manager and the committee the mandate to get on and do a project because everyone's signed up under the Section 74. We see other scenarios where most owners are just head in the sand. I don't want to know about it. I don't want to hear about it. But then again, you've got owners that are heavily impacted. So it's similar but different to the second group I spoke to. And then you get the last group, which everyone's on board with what they want to do, but they just don't have the right people driving the bus. And you've got a whole bunch of people, they could have been going through this for 6, 7, 8 years. You don't know. But you're sitting in a position where you've got too many cooks in the kitchen. There's no one person taking the lead. And the body corporate manager is probably not the right personality for that particular project.
Yeah, that's a good point about personalities and properties, because we've found over the years that certain people suit certain types of properties, and that's not necessarily high-end or mid or whatever, but it's just whoever the committee is at the time, they'll probably get on really well with this person or what have you. I like what you said before about bringing value, like bringing in a point of difference, because I mean you come into the New Zealand market and there's probably a risk that you look like everybody else that's potentially here. So how have you guys sort of tackled that challenge to make yourselves stand out?
Well, it's not doing what others in the market are already doing. So we, I said before, we took the really conscious decision that we would only take on engagements and projects in New Zealand where, number one, we knew what we were doing, and number two, it was a problem that there wasn't a solution for in New Zealand already. Now, whether that was because no one had tried it or because people had tried it and not got there, doesn't matter. And that's our whole MO in New Zealand. So first problem to tackle was modular, and we've done that. The next problem to tackle was leaky buildings and funding for body corporates. We've done that. So 95% of our work is in that space. Now, we do get clients from time to time that are predominantly related to other projects we're doing, where they go, I want to build a hotel, can you help me put the funding together for that? Yes, that's great, because we do that in Australia all the time. And we'll do that because we know it, we know how to do it, but it's not our core business over here. Development projects, land banking, all of those traditional real estate finance style projects we'll do, but our core purpose over here is to solve funding, establish funding solutions for problems that haven't been solved before.
That sounds like your elevator pitch. I mean, that kind of really clearly states what you guys are about, which is really cool. Just wanted to go back to the people side of things before, because when one of these projects happens, in each building you've got a huge range of, dare I say, financial capability.
And knowledge.
And knowledge, so from the penthouse to the first floor, there's a difference in not only height and floors, but financial capacity to deal with problems as they come up. Do you guys ever do you have to sort of get macro in on it like that and sort of help people out in that sort of space where the guy on the first floor might be mortgaged up to his eyeballs and the guy in the penthouse doesn't care, guy or woman, sorry I should say, doesn't care because they're well funded, they've got plenty of money or whatever? Or
we've got two projects that we're working through at the moment that are exactly that scenario. And it's interesting dynamics because the penthouse, they're the ones that are impacted the most, whereas the lower floors are not. The upper floors have got all the money. The guys at the bottom don't. But there's more guys on the lower floors than the penthouses, and nothing's happened. So we're working through that. So because there hasn't been a dedicated solution, and there's been groups and individuals doing a transaction here and there, a lot of what we've been doing over the last sort of 6 months is really around education. So, meeting with people like you and spreading the word that, hey, there is a solution, there is an option out here, and then meeting and having, I spend a lot of time, I live in Australia, I spend a lot of time on Zoom and Teams. The team here are out meeting with committees and owners groups and other stakeholders to have those conversations, pitching to owners and having Q&A sessions. So most of the work our guys do here, it's really a Q&A with the owners. So they're saying, tell me about it, how does it work, do I have to give a guarantee, all of those sort of things. So we've put together short form info packs that the contractors that we work with have, that the body corporate managers that we work with have, that they can share that with the owners so they understand exactly how it works and get them up that education curve, because for a lot of people this is it's new, it's novel.
Yeah, I came across you guys through the Body Corporate Chairpersons group, which we've been a long time sponsor of, and one of your team came in to do a quick presentation, and man, it was like, I just thought that concept was like, I was like, shit, why hasn't anyone else done this before? It was one of those moments where I was like, really, we don't have this? And you guys are coming in and providing it.
Your reaction and your facial expression was exactly what when I got the phone call, I said, I've got this email right at the start. Yeah. Do you know anything about this? And I was like, yeah, we do. Can you help us out? Because there's nothing like this in New Zealand. I was like, what? Really? When I first came out of uni, I worked with a firm and we set up a home warranty insurance company. And I'm talking about early 2000s, right? And even from that time, because all the research around how to build that insurance company and what the risks were, all I heard about was leaky buildings in New Zealand, and that was in the early 2000s. So to come around 20 years later,
still happening,
and find out that there hasn't been a solution, I was like, what?
Yeah.
Look,
slow learners over here.
Well, it's just no one's taken the time to invest in working out how to solve it from a funding solution, and it's not going to work for everyone. But what we've developed will work for a big chunk of the market. So, it's something that we're passionate about. We can see a big problem that we're trying to solve. We can see that it's a really emotional period in time for the owners, and to get them to the point where they're out of the painful and into a position where they're, controlling their own destiny. That's ultimately what this is all about.
I was going to actually ask a specific question around like the success stories that you guys have been involved with over the years, and I guess without naming names and buildings and that sort of thing, like have you got a couple that sort of spring to mind where it was an absolute dire situation and then you guys come along and do what you do and it all works out really well?
Yeah, well, I think the starting point here is that the first transaction only finalised in December last year, so this is really, really new. We spent most of last year working through it, and of all the ones that we've done and looked at, the key one is our first, because I think it was the one that we learnt the most. 200 units, about 200 units, lakefront in Queenstown, very prominent building, enormous remediation cost, part the way through their project. And we were able to give those guys certainty that they could continue funding the stage of work that they were on, that they didn't need to continue to levy the owners, and they could progress with their litigation case and not stop the work. So it gave them the certainty to keep going on the work whilst they were dealing with the litigation. And from that perspective, that's a great outcome for everyone. It meant the contractor didn't need to stop. It meant the owners could put their hands in their pockets and keep them in their pockets. They didn't have to keep going into their pockets for more money. And it gave the lawyers sufficient comfort that they could keep plugging on with the litigation case to get them to the point where ultimately they did get they were successful in settling that case, which then addresses the rest of the work. So, and that was $20 million. So we're not talking. It was a pretty significant funding requirement.
Yeah. one thing that's just sprung to mind while you're talking about that was, do you only deal with existing body corporates, or have you ever dealt with a situation where a developer has gone, dare I say, tits up, and have you ever had to step in to say finish off something that's coming out of the ground? No, it's just purely
No.
Yeah.
So that is something that we as a firm can do, but that's not a body corporate loan.
Yep.
Yep.
Yeah. Okay. Yeah.
Different scenario.
Yeah. Totally. Yeah. Because I mean, yeah, at that top point in time, the developer is the body corporate, but they're not a traditional body corporate as such. They're still the developer, I guess. So.
And we wouldn't, even if it was something that we got asked to look at, we're dealing with one owner, and that's really bad outcome for us, because one of the benefits of a body corporate is that you're diversifying your repayment sources. So if you've got 20 owners, you're not relying on one person to repay the loan, you've got 20 owners to repay the loan. So that, from our perspective, is not, from a BC loan, it just doesn't stack up.
Yeah, it's risk management, isn't it, really, for you guys at the end of the day? What are your plans for MOD in New Zealand? Like, where do you want to go? Where do you see it, say, in 5 or 10 years?
Well, I think it's continuing to do what we set out to do, which is to solve challenging funding requirements that others haven't been able to do. We've got a number of modular projects that are live and coming down the pipe that we're funding, and we're really excited about that. And they range from affordable housing, there's Kiwi build in there, there's just traditional market, and there's some premium products that are going to be rolled out through that. And there's some workers accommodation. So there's a whole spectrum of development projects through the modular piece. And the modular piece is simply to complement what the builders in New Zealand can already build, but like the problem we got in Australia, there's just not enough housing being built. So being able to bring these modules in from offshore and get people into dry, warm, healthy homes, fantastic. And the second piece is to do as many of these body corporate loans as we can to solve a problem that, as we said, has been around for 20 years and hasn't been resolved. So there may be other opportunities that pop up along the way that are niche funding requirements that require a solution that others haven't been able to do, and we'll look at those. But we've got plenty of work on just in modular and just in body corporate that I'd be happy just focusing on that for the next 5 years.
Yeah. Well, what are the limits of the funding? Not so much the top end, but like, say, what would be a minimum? Like, would you fund something to, like, say, replace a cooling tower on a building, or a small project? You'd go to what would be the minimum size project?
One of the partners we have in this space is a mid-tier contracting firm that specialise in remediation, and we've worked with them to be able to build out a product that is tailor-made for long-term maintenance. Some of those will be chunky pieces of work, and that sits alongside the traditional body corporate loan for these big remediation projects. Ultimately, if it's under $500,000, that's really something that the owners should be able to fund themselves. And if they're unable or unwilling to fund a project under, say, $500,000, that
it's a bit of a red flag.
Bit of a red flag for us. So anything under $500,000 is probably too small, but anything over that we can do, and we've got different pots of capital that we're able to tap for these different size loans.
Say $500,000 could be a different amount for a building that's got 300 owners as opposed to one that's got 10 owners. Would you sort of look at
Absolutely.
that?
Well, it goes back to the debt per unit.
Yeah, right. Yeah, cool. Nearly forgot what I was going to say there. It was going to be around. Forgot what I was going to say. There was a question around. I'm just got to remember to cut that out. We were talking about small end loans. Long-term maintenance plan, like that. I'm glad you mentioned that, because you get some pretty big costs in those long-term maintenance plans. Do you guys have sort of partners in New Zealand that you talk about with long-term maintenance plans, or do you wait for that to come through the body corporates? Because we deal with a lot of long-term maintenance plan providers. Would you go through them, or would you go to the body corp managers or to building managers or to get to those people?
Oh, look, we're open to all inquiries. There's not a preference in terms of, we will only deal with this industry stakeholder. But it's important for us that there's track record, they know what they're doing. We actually see their long-term maintenance plan as something that will start to rise in prominence, given the changes to the UTA, that you actually got to go to someone external. It can't be a long-term maintenance plan written by the body corporate itself. There's got to be an external person to come in, and that's going to start to uncover a whole range of works that need to be done. The Australian experience, though, is that just because it's there doesn't necessarily mean that the body corporate's going to act on it. So until the legislation gets to the point where there's liability or penalties or something of the like to incentivise the owners to do the work, I think that's going to be a bit of a challenge, because it's all well and good to have the piece of paper there, but if you're not acting on it, you're not acting on it. So again, the maintenance piece is a newer place for us. It's at the smaller end of the market in terms of the dollar size, but there's no one channel that we prefer to work with. It's as long as it makes economic sense, the owners can pay it back, and the body corporate manager who's on that building knows what they're doing.
It's a really good point, about having people knowing what they're doing, because these projects a lot of the time are only as good as what the person knows about at the time, and unless they know the right people to go to. I mean, we've had remediations in buildings where it's been totally finished, and then a couple of years later they've had to go through the same thing again because they didn't get the right expertise involved at the time. And sometimes that's not anyone's fault. It's just that it may have not have existed, or they just, the person they were dealing with didn't know to contact a certain contractor. So it can be a real sort of lumpy road for certain body corps at times.
Well, the other scenario that plays off the back of that is perhaps the body corporate had options in front of them and they chose that option because it was cheaper and easier, and that's all the funding that they had for it. And we've seen a couple of those projects this year where we're working through funding work that's already been paid for once before. So that becomes a challenge. But in hindsight, you look at it and say, well, the body corporate made the decision that they did with the financial resources that they had available. If they had access to funding, would they have considered a project that was beyond their own financial resources because they had someone else coming in to provide them with the top up in the funding that they would have needed to do the job properly? And hopefully that's the part that we can bring to the party to help them do the right job, rather than the job that is all that they can afford at the time.
Oh, that's a bloody good point, because the availability of the resource at the time can affect how you think and which avenue you take. And if you're looking a bit skinny on one side, you think, oh, we've got to go down this track. But if you've got the resources available, you think, oh, it kind of opens up takes the blinkers off a wee bit.
And we've got a couple on the books at the moment that are exactly that, where the body corporate managers come and said, oh, we're going to do this, but they don't have enough money to do everything. Would you look at it? We're doing a preliminary assessment of the situation. Said, well, if they've got X in the bank and they need Y, we can absolutely do that top up, and that'll give them the runway to do the whole project. So what that actually causes them to do is go back a few steps and start considering a different option for the project, because they've got new information, they've got access to additional funding that they didn't have when they first set out on the journey. So we've actually been in a situation for a couple of buildings where we've said, yes, we can do it, but that's meant they've had to go back and start the planning again,
right? Because
the projects have changed.
But you're better off to be doing that, doing it once, doing it well. If you have to take a couple of steps back to go forward, then so be it.
Yep.
So once the project's completed and they've got to start, what are the terms for the repayment of the finance?
Yeah. So at the moment, we're looking at about an average loan term of 5 years. Some loans we can do a bit longer, some loans we'll have to do a bit shorter, and that all depends on the size, the characteristics of the funding requirement. Ideally, what we do is it's interest only
Mm.
through the term of construction.
Yep.
And then from the point where the building is finished, we start looking for principal and interest.
Mm.
And the reason we do that is a couple of reasons. Number one, if it is a traditional build and they get compliance, they're then able to go back to their lenders and renegotiate the mortgage and use that equity to repay the loan. Perfect.
Mm-hmm.
It also allows those owners that have mentally just done and want to move on with their life to sell, but sell at full value. Tick. It also means that the money that the owners are having to fork out of their own pocket on an ongoing basis during the remediation, they might be out of the house. They might be living somewhere else. We can smooth the cash flow out, and then when they're able to move back in, they won't be paying rent on the other place plus their mortgage, so they'll have a bit more cash to be able to put towards principal repayment. Then there's the scenarios where there's, there might be a claim against another party, let's say the council, for example. Can we time repayment of the facility to when the settlement of the council claim is likely to occur? And they're all the things that we'll look at on a case-by-case basis to make sure that we're doing the best we can to align cash flow requirements for the loan with the cash flow availability for the owners themselves.
So 5 years, that sounds like a pretty reasonable term. That's more like a commercial loan rather than a mortgage. So
Absolutely.
Yeah, that works well.
We're continuing to identify additional capital partners that will give us the runway for longer funding.
Yeah.
And there's some usual suspects when you think the New Zealand market. You've got Kiwi Savers, you've got the super funds and the like. But like banks, their concern is, this is untested, this is new territory. I can't put funding into something that I'm not entirely sure how it's going to pan out. So the more we're able to do, gives us greater track record of what we're doing, gives us greater number of transactions that we can then take to those really suitable funding partners for them to get involved. I can't think of anything better for the New Zealand market than super funds who are long-term investors getting involved in this part of the market and extending it to 10-year term, 15-year term, which really brings down the cash flow requirement. They'll be cheaper money, which means the funding cost will come down, and it aligns with what their mandates are on fixed income investment. So that's ultimately where we want to go, and we'll continue to work on getting there.
That must be an interesting aspect of what you guys do, is dealing with those lenders, or the people that you guys source your lending from, and to go to them and present a case. Is it a case by case basis, or do you sort of go for a big chunk of money? Like when you go to those lenders, is it, do you go, well, here's a building, or you go, here's a pipeline of projects?
Yep. Yeah. So we approached it. We went down those paths at the same time. So whilst we were working on a deal by deal scenario, we've been talking to some institutional money about getting commitments on facilities, or give us a commitment for 50 million, 100 million, whatever the number is, depending on the party. Every time we went to, particularly the super funds, the financial institutions, the banks in New Zealand, there's a real reticence to get involved, and part of that is it's the unknown. So until we get more deals done, repaid, it's going to be hard to go to those other parties and say,
yeah, you got to build up your track record, essentially.
Correct.
You've got to show, here's the proven track record of work and projects that's happened, and been paid back.
And I think the interesting thing at the moment is most of the funding that we're accessing is coming out of Oz.
Oh, right.
So some of the smaller deals are funded from high net worths in New Zealand, but invariably the medium to larger tickets on the loans are all coming out of Australia. And the sole reason for that is it's a semi-mature market in Australia, and our capital partners over there, body corporate lending, that's what we call strata finance. Yes, it is. Oh, okay, yeah, we'll do that.
Yeah.
Strata
finance sounds way better than body corporate lending.
But
yeah,
it's just that education and the familiarity with the space. So the more of these we get done, the greater the track record and the greater take up and acceptance in the industry, the more that will give us to be able to go into the banks, into your fixed income fund managers, into your super funds, and get them to listen. And I think a lot of them gave us a good hearing. Like there's very few that we dealt with that we thought we didn't get a good hearing. A lot of them are unnecessarily concerned about the risk, because we can map out, if this happens, this happens, if this happens, this happens. It's really, really clear. Oh yeah, they don't want to be first. So we're doing that, and hopefully we can roll that into a larger push for institutional capital out of New Zealand. Because in my mind, nothing better than an institution in New Zealand solving what is a systemic issue in New Zealand.
Like what you said before we started about how you go in there and you fund that first stage, I guess. But you get that the invasive investigation done, and then you kick on from there. Because from what we see, the project gets approved, they obviously get their funding, they start ripping off the walls and things, and 9 times out of 10, we've got a bigger problem, it's going to cost us go like that. Not to say that doesn't happen, with the way that you guys operate too, but at least you're not sort of, what do I say, you know that the initial amount is not, it can't be the final amount. It's going to be that. You're doing that investigative part.
Yeah. So for us, we can't be in a situation where the remediation cost explodes, because we're then in a situation where if the owners don't turn around and say, yeah, we're happy to fund it to get it finished, then by implication, we're going to have to step up and do it. If we want to get repaid what we've already put in, you're almost doubling down. And that's really uncomfortable for a debt provider. So our preference is always to have an invasive assessment done of the building. And if it goes, there's 2 scenarios. So number one is a building will come to us and say, we've spent some money, we've gone in, we've had a look at what the problem is. We thought it was just the curtain wall was leaking, but we then pulled something off and we found out that there's passive fire issues, that we've got rotten timber here, that the building's not square, and we now know the full scope is this. That's great for us because we're comfortable that they've actually ripped off the Band-Aid, gone in and had a really good look and understand what the true scope is. And we'll look on funding on that basis. It would be hard for us to fund or make a commitment to fund a project where none of that work had been done. So what our preference is in that front is, if the owners haven't done a full exploration, invasive assessment, then we'll look at providing some funding towards that, but we'll need them to contribute as well, because that's really an equity component. But if we're being asked for a reasonable amount of money that sits well within our LVR and debt per unit ratios, then we'll look to provide that funding for that purpose only. Because if they're going in to do an invasive evaluation of the building, they're not upsetting the apple cart on everything else. Now, they may decide not to proceed with the project, that's fine, and then they just pay back our loan on the terms for that facility without us needing to get concerned about a blowout in the project costs. So that's one way that we can manage the 2 different scenarios. But it's really important, particularly on larger projects, that we know what the scope is, because we can't have there's one building that we spoke to originally and it was going to be 24 million in Auckland. They did exploration. That combined with inflation and a growth in construction costs now means it's a $48 million remediation project.
Double.
So you can imagine if we've gone in there and funded $20 million and then it turns into 48 and the owners can't make up the shortfall, we've had to double down to get our first 20 out, and we don't know whether the 48 on this particular building, 48 would be quite highly leveraged, but it wouldn't be worth more. It'd be sort of 50% of the total building value, not 100 plus.
Right.
Which is, if it's 100, if we get into a position where we're 100 plus, that's just can't be there.
Sheesh. Yeah, it's a hell of a it's a big fright for a lot of people to get, isn't
Absolutely.
it? Absolutely. Yeah. I guess we're probably coming towards the end and stuff, and hopefully we've covered off a fair bit of ground. But the what I was going to ask around, what percentage of your clients actually do what you said before about doing, say they do levy and debt as opposed to just debt? Like, is there a sort of a trend that happens there? Or do a lot of people just go for the debt, or do they try and do a bit of 50-50 or whatever?
So we haven't funded or even issued term sheets on any project where we're the sole funding source. Every project we've been involved in is either we're putting money in alongside the owners, or the owners have already put money in to get them to where they currently are.
Right, yep.
And part of that from a lending perspective is, I want to know that, we look at two things. There's got to be a willingness to do something and also the ability to do something. And if a building's turning around to us and saying, we don't want to put any money in, but we want you to do that, or I don't know about the ability, but there's not a willingness to do that. And that sends a lender some really clear signals that if things start to go a little bit pear-shaped, these guys are already signalling that they don't want to put money in. They're worried about it. They think there's a risk there, and they're trying to transfer the risk to a lender. Well, we're a lender. We're not the owner of the unit. We don't get any benefit financially if the project's finished and the value goes up. But we have a real issue if you don't do anything and we're stuck on a building that never gets repaid because the owners don't want to do it. We lose on that front. So it's all downside risk and no upside risk for us. So everything's got to be that the owners have put in some money, and we're not asking for everything, but we want to have that signal from the owners that they're willing to contribute to this problem as well as us, and that's generally what we're seeing.
So worst case scenario, what happens if they default, or can they ever default, or has that ever happened? Like if they default on the
again, this lending product is so embryonic in New Zealand, we haven't even got to the point where anyone's defaulted.
Right, yeah.
Yay,
happy
so
days.
far. But the Unit Titles Act provides a really clear mechanism that our loan agreements are built around. So if an owner is in arrears on its levies, the body corporate can seek the default judgment against that owner to, one, make them pay, or two, if they don't, take possession of the unit and sell it. That's really our only mechanism to recover funds for a recalcitrant owner that doesn't want to pay or won't pay. And we have had that situation where we haven't had to do it, but the body corporate did. And that was fantastic because the body corporate said, we can't be in a position where, because of this particular owner, just put their head in the sand, said, nothing to do with me, I'm not going to pay. The body corporate went to court, got the judgment, sold up the apartment. Fantastic, because it means it's not, we don't want to be kicking anyone out of their house. And it was great from the body corporate's perspective that they took the initiative and did what they were able to do under the Unit Titles Act.
I guess it's always a concern about, lending any sort of money is, am I going to get it back? So, it sounds pretty robust in that regard. So, mate, it's been a really good chat. I've learned quite a lot just sitting here and just, listening, and, it's really got the old brain spinning, and, I hope you guys, continue to grow your presence in the market, and, we'll certainly do what we can as well, and through the Body Corporate Cheers group and that. So, thanks for the chat, and, man, good luck with everything, and hopefully we'll cross paths again, and
absolutely.
Keep it up.
And look, thank you for the invitation. It's been a great session. It's been a great chat just to talk through the education process. Letting your listeners know that and your viewers know that it's available, that we can help, that there is potentially a way out of of these kind of problems. And we'd love to come back and share some success stories down the track of other buildings we were able to help out of a pickle.
Yeah, no, I'm sure there'll be plenty, mate. Thanks for that.
Pleasure.
Cheers.
Thank you.